Well, good afternoon, everyone. Thank you all for being here today. It's a pleasure to be with you, to be talking about South Carolina's economy at our 38th Annual Economic Outlook Conference. A lot has happened in 2018. As you all know, things have changed since we were all together approximately this time last year. And so I want to spend the next few minutes this afternoon talking about what South Carolina's economy looks like today, what has changed over the last year, and where we're headed in 2019. So to start out, to give some brief background, I think it's important to reflect where we were this time last year. And so really to reflect on some of the major conclusions that we came to at this time last year in December of 2017. The first one, as you see here, was that at the time, again, thinking about 1 year ago, the economic fundamentals were very strong, and that was true at a U.S. level and in South Carolina. And then the second point was that when we were looking ahead to 2018 at the time, we said that the economic fundamentals were sound and that the biggest potential risk factors had to do with policy, with major changes to policy, either on the monetary or on the fiscal side. And that has turned out, as we all know, to be the case. And in 2018, the market fundamentals continue to remain strong, which I'm going to go through some evidence for that in a moment. But we've seen some major changes in policy this year that has really increased uncertainty or created a more volatile market environment in 2018, certainly compared to what we had seen previously in 2017. So what do we mean specifically when we're talking about volatility? What are the specific differences that we've seen this year? Well, there are four main components of the uncertainty that has been introduced this year. Number one, of course, is the new tariff activity that we've seen implemented across in the United States, and we're going to talk more specifically about those effects on South Carolina later this afternoon. We've also seen an increase in interest rates this year at a more aggressive pace that has had effects on markets across the U.S. and in South Carolina as well. We've seen some slowing of global markets, particularly in the Eurozone. And then also, we are now in the 10th year of this current economic expansion. And you look at that and you say, well, why does that generate uncertainty? And the answer is that when we have an expansion that extends for a lengthy period of time, it begins to raise the question of how long will this expansion last? And so we get more speculation about the possible end of the current economic expansion. And again, that generates from a psychological perspective more uncertainty, more volatility. So four factors that have really introduced new volatility in 2018. And we've seen that in terms of the data manifest itself, especially in the stock market. So coming off of 2017, last year, in 2017, we saw stock market growth of about 25% for the year, so an incredibly strong and positive year. But 2018, as you can see here, has been fairly flat overall. So gains year to date have been slightly up or down, depending on the day that you look at, but effectively zero for the year. So as I mentioned, the fundamentals of the state and the national economies do remain strong. So we've seen strong growth overall. Of course, that doesn't necessarily extend to every individual sector. But I want to spend the next few moments with you this afternoon talking about some of these market metrics that we're looking at and why we still see the U.S. and the state's economy as performing very well as a whole. The first thing that we can look at is GDP growth, which is our single best proxy for the health of the U.S. economy as a whole, and this tracks it back to 2010. And you can see here that growth has been, even though it has been somewhat volatile and has stabilized a bit in recent years, so there are not as many large, very high bars followed by very low bars, so significant growth followed by very weak growth. That's stabilized more in recent years. You can see that the bars were more consistent with one another. Overall, through 2017, growth averaged during this expansion of between about 2 and 2.5%. So GDP growth was between about 2 and 2.5%, and that's fairly weak by historical standards. So 3 to 3.5% is more of the norm of what we would expect for an economic expansion before the ones that we saw before 2010. So that's about a percentage point difference. Now in 2018, what's new? What's new is that we've seen an acceleration of this growth. So 3.5% is our latest estimate in the third quarter. That's coming off of 4.2% growth in the second quarter. So we have seen a sizable uptick this year. And the question is why? What's changed? What's been driving that growth? And is that likely to continue? So just briefly, we can go through the components of GDP. We always want to go back to the fundamentals and keep our eyes on the fundamentals. So if we think of GDP as a function of consumer spending, private investment, government spending, and net export activity, so exports minus imports, if we look at each one, we can get a feel for what's been driving this growth. So let's start by briefly looking at personal consumption. So this is a chart that reflects growth over time. So what we've seen is a fairly steady growth rate for the last several years. So a flat line here, this arrow, doesn't mean zero growth. It just means a steady rate of positive growth. So a flat line there represents consistency, and it represents a positive trend overall. And that actually saw an uptick, as you can see here in 2018, that was partially due to the tax cut package that was passed in 2017 that provided additional dollars in many households across the U.S. and generated more disposable income and thus an uptick in consumer spending overall. So that was certainly an important component that we've seen in terms of the boost to growth that we've seen in 2018. We can also look at private investment. Also has seen an uptick in 2018. And this has been somewhat of a weak spot when we look at this expansion overall. But definitely an uptick in 2018. But in this case, it looks more like private investment, unlike consumer spending, which both saw a positive boost due to the tax cut in 2017. Again, on the investment side, we saw a decline in the corporate tax rate from about 35 to 21%. There has been a bit of the momentum has slowed a bit in the most recent quarter's worth of data. So it looks like it might be the case that consumer spending, the uptick in consumer spending is more sustainable than the uptick in private investment. This may more be reflective of a temporary stimulus as opposed to something that is long-lived over the next several years. And we can actually see that in other data series as well. If we look at surveys of different business personnel, this reflects a survey from Duke University in terms of the CFO expected capital spending growth over the next 12 months. So this is just a survey to try and get a feel for what businesses are likely to be doing. And as you can see, that saw a sharp uptick in early 2018 and has settled down a bit since then. So again, if we look at the consumer spending part and the business investment part of GDP, having slightly different reactions and long-term reactions to the tax cut that was passed in 2017. Now let's talk about changes in export activity, in net export activity. I'm going to skip over government spending for now because we're not expecting that changes in government spending patterns are going to have there are no projected major changes that are likely to have a significant impact on our outlook for 2019. But for exports, that's not the case. So we've seen some major changes this year. You can see a bit of a downturn here in 2018, largely due to the tariff activity, which we're going to be coming back and talking to more specifically later this afternoon. But in addition to that, we've also seen a bit of a slowdown in global markets, particularly in the Eurozone. So this just gives us a snapshot of what's been happening in terms of GDP growth in Eurozone markets for the last several years. So again, fairly weak growth, certainly compared to the U.S. overall, but you can see a definite difference in the trend, a new trend being established in the last year or so, which has had an effect on U.S. GDP as a whole and export activity in particular. So as I mentioned before, we want to keep our eye on the fundamentals, and this is a nice way that we can encapsulate this, just looking at what we expect for 2019. And if we go back to GDP growth, and thinking about the growth that we've seen in excess of 3% in 2018 versus the growth rate of between 2 and 2.5% that we saw before 2018, which one is going to emerge in 2019? And I think it's largely going to be a battle between whether or not the private investment boost that we have seen overpowers or does not overpower the changes in net export activity. And again, there's a lot of uncertainty here because, as we're going to talk more about this afternoon, we may see some resolution to the changes in trade policy that may positively impact what we're currently expecting in terms of export activity. But those are the two variables to really keep in mind in terms of 2019, whether we get to growth above 3% or whether we revert back to our new normal of 2 to 2.5% for this expansion overall. All right, so that's a brief overview of what's happening nationally. Let's talk also about what's happening locally in South Carolina. How do these trends affect us here in South Carolina in particular? Well, there's several ways that we can look at this. The first is to get a broad sense overall of where we are in South Carolina, what's been happening over the last 12 months. And the best way to do this is to look at employment growth, which is the single best metric that we have for the health of the local economy, for the health of South Carolina. And this gives us a picture of what's been happening for the last several years, going back to 2011. And as you can see, during the early part of the expansion, we saw a steady uptick in employment growth. Part of that was a direct response to a significant recovery coming out of the recession, as well as a large number of major job announcements in manufacturing in particular that drove that higher rate of overall employment growth. But in the last several years, we've dropped off a bit and have reached more of a long-run equilibrium, or more of a steady state, I would say, because some of those growth rates that we saw during the early part of the expansion certainly weren't sustainable, because we had periods of growth in excess of 10% in certain sectors. And again, that was wonderful for generating these new jobs, these new job announcements, but that is not a sustainable rate of growth. So where we are now is more, again, more of a long-run equilibrium or a steady state, which has been about 1.8% over the last year. And as you can see, employment growth has remained fairly steady. And so as a result, when we look ahead, what are we going to expect in 2019? What is likely to change from what we've seen in the last year? This is just a preview to jump ahead to the conclusion here. Employment growth for 2019, we're expecting to be very comparable to what we saw in 2018. And I'm going to go through and talk about why. But as you can see here, 1.8% is what we're expecting for 2019. It varies, of course, by quarter, depending on when we're looking. But in general, we're expecting economic growth to remain fairly steady at about the same rate. This is going to also put downward pressure on the unemployment rate overall, which you can see here. We expect to dip to about 3.1% a year from now, down from its current rate of 3.3%. Not a whole lot of room for it to drop, given the tightness of the labor market and where we are right now. But we continue to expect to make gains in employment across the state. Now, why is this the case? Why are we expecting growth to remain fairly constant? Well, right now, we're engaged in what I would call an economic tug of war. That is, we're having very steady job gains, income gains across the board. We've seen this uptick in consumer spending, but that's being balanced against some of these policy changes that I highlighted before and that we're going to be talking more in detail about. So in addition to that, in addition to this economic tug of war, we have to look at that as one component. And then secondly, we also have to look at the industry composition in South Carolina, because we are seeing steady growth overall. We're expecting that to continue, but different industries have responded differently to some of these policy changes that have emerged in 2018. So let's break down the growth into the major super sectors in South Carolina. So you probably can't necessarily read all the different sectors there, and I'm going to sum them up for you. But the bottom line here is that if we look at the blue bars, those represent growth patterns from 2017. The brown bars represent growth patterns from 2018. So it's useful to look at which industry sectors have seen significant changes from 2017 to 2018. And then we want to consider why as we're looking ahead to 2019. And as I mentioned, we'll kind of jump ahead here, and I'll put some arrows on here so you can get a feel for who's up and who's down and who we need to be looking at. And I just want to spend a little bit of time going through three major industrial sectors in South Carolina that have made the biggest changes over the last year. And that would be construction and housing markets is one, manufacturing is two, and trade and tourism is the third. So three industry components that I want to briefly go through with you this afternoon. So let's start by talking about construction and housing markets. What has changed there in 2018? Well, this is a good snapshot of essentially what we've seen in the housing market overall. A steady uptick for the last several years. This reflects new and resale homes at the national level. We would get a similar picture if we looked at these data in South Carolina too. But the bottom line here is that we've had a steady uptick, steady growth over time, which really leveled off and saw a bit of a decline in the last 6 months. We've seen fewer home sales for about 6 consecutive months now. And so the question is why? What has changed in 2018? And the answer is that there have been two factors at play here, one of which is new, and one of which has been in play for quite some time. So the one that's been in play for a while is the rising builder costs. And we hinted at this a little bit last year as well. The builder costs have been going up because of increases in lumber prices and increases in labor prices, that is, increases in wages. And so in both cases, that has put upward pressure on prices overall, which has affected demand. But that's not new. What's new this year is the combination of those factors with rises in interest rates, which have taken a bit of time to take hold in the marketplace. But because we've seen a steady increase in the federal funds rate, that has translated into an increase into mortgage interest rates. And so when we combine the two, we see an uptick in prices that is having basically a blunting effect on some of this momentum in terms of the steady increase in demand that we have seen. So that's new in 2018. Again, for the first time, we're beginning to see a bit of a downturn in sales activity. Now, the good news is that going forward in 2019, if we look in South Carolina, housing markets, number one, remain very stable. Demand remains very strong. And the Federal Reserve, Jay Powell, the Federal Reserve Chair, has indicated that we will likely not see as many rate increases in 2019. So we may see the Fed reducing the rate at which interest rates are rising in the coming year because they recognize these trends as well. So in South Carolina, we can actually see the stable growth. So we see the demand in terms of steady job growth, and we also see, if we look at house price appreciation metrics, you can see that growth has been fairly stable overall. Again, in this case, a flat line represents a consistent positive growth rate, which is what we want to see. Charleston's at the top, Greenville is in the middle, Columbia there is at the bottom, but all three are moving in the right direction. And they all reflect the demand parameters that we're seeing in South Carolina. Namely, if we order them, Charleston, Greenville, Columbia, that exactly follows the overall employment growth that we've seen in the state. So housing growth, housing demand directly tied to job growth, and we're seeing that play out in the data in multiple ways. Another way that we can see this is if we look at the employment to permit ratio, which gives us a way to measure future demand versus future supply. So employment, obviously a proxy for future demand. You can't buy a house if you don't have a job. And permit activity represents future supply. So when we look at the EP ratio, it's not important necessarily to look at the metric itself in terms of the value, but rather to look at how that value changes over time. So if the EP ratio is increasing over time, it indicates that we're seeing a pent-up demand. There's more demand building up relative to supply. If the EP ratio goes down, that indicates an overbuilt market, and a fairly flat EP ratio indicates essentially a market equilibrium. So what are we seeing in South Carolina? What are we seeing in the different markets? Are we seeing a healthy housing market by this metric? And the answer is yes, we are. So all of them are moving in a positive direction. These are indexed values, and this tracks from 2010 to 2018. But you'll notice that one market is very different from the other three. So hopefully you can see that Columbia doesn't quite have the positive slope that the other three markets do. And again, this is a reflection of the overall demand structure that we're seeing across South Carolina. But in general, again, all three markets appear healthy, responding to positive demand. So despite the fact that we've seen a blunting of some of the momentum this year due to rising interest rates, we're still fairly optimistic about housing in the new year. All right, let's change gears a little bit and talk briefly about manufacturing trends in South Carolina. What have we seen here in the last year? Well, essentially, manufacturing still remains positive in South Carolina, but the growth rate is about half of what it was in 2017 due to multiple factors. Again, number one is the tariff activity, and number two is the decline or the reduction in the growth that we've seen in the Eurozone countries in particular. So what have we seen in terms of the manifestations of these changes in manufacturing in 2018? Where can we see the effects of this? Well, one way is to look at the cargo volume coming out of the South Carolina Ports Authority. So you can see a significant difference here in terms of what growth rates have looked like in 2018 compared to the majority of the rest of the expansion here going back to 2012. So we are seeing some actual ramifications of these changes. Export volume is certainly one. And the second, which I think is also important to point out, is looking at the changes to the employment services sector in South Carolina. So the top green line there represents effectively advanced manufacturing, or what we're calling here transportation equipment manufacturing. But the bottom line represents employment services, and that's a way that we measure contingent labor. That is, employees who are working for companies through a staffing agency. And so you can see that in particular has seen a bit of a drop-off in 2018. And one of the things that we have found over the years is that manufacturers rely more so than many other industries on employment services, on a contingent workforce. And in part, this is an advantage to them because it's providing them with more flexibility, particularly in a time of uncertainty with respect to the automotive tariffs. And so you can see this flexibility here in terms of some of the volatility that employment services has seen this year. But keep in mind that when we look at the direct hires as represented by the green line, that's remained fairly stable. So again, this provides some alternatives, some flexibility, and a way to efficiently handle some of the uncertainties that we've seen with respect to the tariffs in 2018. And then finally, let's talk a little bit about trade and about tourism. And when I say trade, I mean retail trade, wholesale trade, and consumer markets. And this is a real bright spot in South Carolina this year. Because consumer spending has been up, as I alluded to before, we've seen about 80% of households experiencing a tax reduction this year because of the tax cut that was passed last year. And we've also seen a significant drop in gas prices in recent months. So all of these give us reason to be optimistic for 2019 in terms of consumer spending overall. We've seen the uptick, and we expect that to continue into the new year. And we see that specifically, too, in the data. So if we look, again, at wholesale trade, we look at retail trade, we look at leisure and hospitality, which is our essentially the way we measure tourism markets, or one way we measure tourism markets. Here you can see positive growth across the board in excess of what we saw in 2017. And again, we expect this to continue into the new year. And this is also impacting our forecast for income growth as well. So if we look at our outlook, you can see that we're anticipating a bit of an uptick in 2019. We anticipate wages continuing to rise. And of course, wages are a subset of total personal income growth. So gains in this area as well in terms of where we're headed in 2019. And then finally, we can also look at what's been happening at the state level. And then breaking that down by region. So I want to compare two maps here to give you a sense of what's been changing over the last several years. So this just gives us a snapshot of the state going back to 2010 in terms of areas of high growth, fairly low growth, so dark green versus the more yellow color, and then red, which represents employment losses. So the dark green clearly represents the major areas of the state that have seen the most sizable growth throughout the expansion period, not surprisingly, concentrated primarily in Greenville-Spartanburg, also in the Rock Hill area because of spillover effects from Charlotte, and then in the coastal regions as well, so Charleston, Myrtle Beach, and Hilton Head. But look at what's happened over the last year. So this is 2010 to 2018, and now I'm going to change it out, and let's look at 2017 to 2018. So how does this look a bit different? So flip back and forth there just for a moment. And so two things really pop out at you. One is that the number of red counties has dropped. So we've seen positive growth across most counties in South Carolina this year. And in fact, more generally, we're seeing more growth in some of the second tier or some of the smaller metropolitan regions because we've had enough time now in this expansion where growth is benefiting some of these smaller MSAs and that was not the case early on. And then secondly, you'll notice that growth has shifted east, mainly away from the upstate. So Greenville-Spartanburg are not in dark green when we look at what's been happening over the last year. And again, this reflects changes in manufacturing that we've seen in 2018 due to the tariffs and due to the slowdown in European markets more generally. So what is the bottom line for 2019? As I mentioned, strong growth overall, both at the U.S. and the South Carolina level. We've seen the fundamentals across the board remain strong, particularly in South Carolina. But we do have a much higher degree of uncertainty this year, as we've talked about, due to rising interest rates, due to the tariffs. And if we look ahead to 2019, this has led us into basically an economic tug of war. So we're not currently, and I underline currently, expecting growth to increase beyond its current rate because, again, we have positive job and income gains pulling us in one direction. We have the tariffs and rising interest rates pulling us in the opposite direction. But, and this is the last important point here to focus on, March 1st, 2019. That's a date to keep in mind because the G20 over the weekend suggests that we may get a positive resolution to some of the tariff activity. So we want to keep our eye on what happens over the next 90 days. Dr. Woodward's going to talk more specifically about the implications of changes in tariff policy. But the bottom line here for South Carolina is that if we do get a positive resolution, that could significantly affect our expectations, particularly for the second half of 2019. And just to put a fine point on that, we've looked at the possible impacts of, or the likely impacts that tariffs have had in South Carolina, and we anticipate that 1.8% employment projection that we currently have for the state could be boosted as much as 0.4 percentage points, or about 6,000 jobs in 2019 if we get a successful resolution. So another way to say that is that right now we would be seeing approximately 6,000 additional jobs created in South Carolina if not for the tariffs that have currently been implemented in the U.S. and that are affecting us here in South Carolina. So it's a significant amount. So we could potentially see a big boost in 2019. It's a wait-and-see approach, but the bottom line is that we are expecting either a good year or a great year in 2019. We don't know which yet, but it's not likely to be a bad year. So I will stop there. Thank you very much for your attention, and we'll be taking questions later this afternoon, so please keep those in mind, and we'll be circling back shortly. Thank you.